If you've been watching the news, you've probably noticed that the Federal Reserve has lowered interest rates. Okay, well, if you're like me, you might be wondering, so what does that mean to me? Do I get anything out of it? How is that going to affect me? Well, I've got all those questions too, so that's what we're going to talk about today. So if you want to know more about that, please just stay tuned. Hey, good morning, everyone, and welcome to Scan FYI. My guest today is Mike Powers from Garden Savings Federal Credit Union. Welcome, Mike.
Thank you for having me, Andrea.
Well, you are exactly the right person to talk about this. But before we get into it, why don't you just tell us a little bit about yourself and what is your role at Garden Savings Federal Credit Union?
Sure. My name is Mike Powers. I'm the president and CEO over at Garden Savings Federal Credit Union. We're about a $420 million financial institution, headquartered in Parsippany, but with 3 other branches and lots of easy access for people to join us wherever they are at gardensavingsfcu.org.
So I will have all of the contact info in the description, and I'll just say unsolicited testimonial. I'm a customer banking online. It could not be easier, so don't hesitate. All right. Meanwhile, the Federal Reserve lowered the rates, but Mike, what does that even mean?
It means a number of things, but it doesn't necessarily mean a lot of things immediately. As I was mentioning to you before we began, that rates when they get lowered are not necessarily a one-to-one correlation with rates being lowered at financial institutions. We had a lot of phone calls last week with people saying, I see the Federal Reserve lowered the interest rates by 0.5% or 50 basis points, as we would call it. And what does that mean? Does that mean all of your rates dropped? And that is not necessarily the case. It's not always a one-to-one correlation. It could be in theory, but it's typically not. For instance, any kind of loan rate, such as a home equity loan that's tied to an index, those you should see drops in your interest rate, whether your loan resets monthly or resets every 6 months. The next time your loan resets, you should see a lower interest rate because it's tied to an index.
Okay.
CDs and certificates and savings rates, those might drop a little bit quicker, unfortunately, than loan rates drop, but they will come
Going
down.
up, not down.
Yeah, right. Yeah, the CD rates will go down too. Everything will go down as the interest rates go down, which is good on the loan side and not as good on the deposit side if you're a depositor. Because rates that were, a couple months back, people were able to get, a couple weeks back, people were able to get 5.5% on certain CDs, and you're already seeing that down to where best rates are about 4.5 now. So those have come down pretty quickly. We did lower our rates a little bit as well, but they're still in the fours. Now, what I would tell people to do, and what I've told my own family members to do, my parents are 79 and 77 respectively. My dad's always asking me, what are you investing in? What do you recommend I do? And right now, what I was telling him with this interest rate drop, I said to him, what you want to do, if you can grab stuff in the fours right now, grab it. And if you can go out to 12 months, 18 months, we still have rates in the fours on that. That's a good strategy because everything we are hearing, and nothing is ever etched in stone.
Right.
Rates when they escalated a couple years back, escalated at an unprecedented clip that threw every financial institution for a loop. They will not drop as quickly, but they will drop. And we are hearing that there will be an additional 50 basis point drop between November and December's Federal Reserve meetings. Now, again,
That's
not
this
etched
year?
this year. Yeah. So rates should be coming down again before the end of the year. Again, so many things can change between now and then. But right now, based on, there's a lot of factors they use in determining how much they lower it. A lot of it is tied to unemployment, and that part gets a little bit beyond my pay grade, but that, how they price it. But nonetheless, what they're trying to do is curb all of that. So as these rates come down again, then you're going to start to see more and more rates come down on the loan side, which is good for the borrower, the person looking for a car loan, the person looking for a mortgage. Rates are going to be coming down. Will they ever get to the point that they were? a few years ago where people were getting mortgages at 3.25%, 3%. I'm not sure they're going to get that low again. But in short, as I was saying earlier, I would say that to my father and to everybody listening, and for myself even, if I can get rates in the fours right now, I would do it, because those rates that you can get in the fours and lock up for 12 months, 18 months, maybe if you're lucky, find something that's out for 2 years. If you can get those rates in the fours for that long, my advice would be to go for it, because especially if you're looking for secure money. And at Garden Savings, we have $250,000 insurance from the NCUA, which is the credit union equivalent of FDIC.
Right.
Plus we have $250,000 worth of private insurance through a company called ESI. So really our accounts are insured up to $500,000. But rates could very well be on the CD end in the threes within the next 3 or 4 months. So if you can lock
Oh.
up something in the fours for, 9, 10, 12, 18 months, that's what I'm going to do personally.
So, all right, so now I have to absorb this. That's a lot of information. So your average consumer, I'm the average consumer, and maybe you've got your credit cards and you don't pay them off, so you're paying interest.
Mhm.
So might interest rates on my Visa cards or my American Express, might they ultimately come down?
They should, because those are typically tied to an index. So
Okay.
every bank does it differently. Every financial institution does it differently, what index they're tied to. But as rates come down, yes, that index should lower and your rates should come down on credit cards.
But if I already have, say, a mortgage or a home equity loan, it's already established at X rate, that does not change,
Now,
correct?
fixed rate products stay fixed. So if you
Okay.
have a 30-year fixed rate mortgage or a 30-year fixed rate home equity or 20-year, those are not going to change because they're fixed rates. So another question that I get often on things like that are, well, how far do the rates have to drop before you recommend I refinance my loan?
Right.
And when it comes to refinancing, generally the rule of thumb I give people, and again, I'm not a doctor on this, so people can feel free to disagree with me, but I say it starts getting to the point where it's worth refinancing once you can save at least 100 basis points or 1% off your mortgage. Otherwise, if they only drop 50 basis points like they just did, and mortgages didn't even come down quite that much yet, more like 3/8. So as rates are coming down, because when you refinance, there's always closing costs, right?
Right. Yeah.
So if you refinance and there's closing costs, then you have to be careful not to refinance just to get 50 basis points lower. It may be offset by your closing costs, and then you went through a whole process for nothing.
Okay, so that's kind of an individual thing. Everyone has to figure that out for
Yeah,
themselves.
at the end of the day, everything is everyone's personal decision, right? You take a look at your own financial picture and what's more important to you, and how much money in savings is worth the effort. It might be a smaller number for some people and a larger number for other people, but everybody should be in tune to what is going on in case something has changed enough that they want to make a move.
So I guess you would reap the benefits of the reduction in rates that would come if you were borrowing money, if you were getting a mortgage now or getting a loan.
Yeah,
Because
if you were,
hopefully now well, when I say now, I mean today. I mean,
yeah.
it only happened what, a week or so ago?
Yeah, it happened last Wednesday.
Okay.
There are two more Federal Reserve meetings this year in which the rates could drop again. So I would not recommend anyone run out off of this one rate reduction and go
Okay.
refinancing their mortgages, because there's more to come and they're only a couple months off. And after there's significant rate drops, most likely, I don't know if I'm allowed to speak on behalf of the Fed, probably not. So
Okay.
most likely the rates are coming down again. And when you'll really start to see savings is when those rates fall more than 1%, which could be by the end of this year. And then they're talking about more rate reductions next year. So you may want to wait it out a little bit and see when the right time is to either refinance, or if you're waiting to buy a home or get a home equity or buy a car or whatever the case may be, you may want to wait it out a little bit longer than you've already waited it out to reap the full benefits of what
Okay.
could be happening.
Right. Well, that makes sense. That really does. And so the folks that are going to notice a benefit from the rate reduction comes on the side of borrowing money,
That's correct.
not, yeah, okay. Savers don't really get the benefit of this.
Yeah, savers, we
Very unfair.
savers, I would say we had our moment, for the last 2 years when
We
rates
did have our
were getting
moment.
up there. And it was nice to see rates get that high again. It was really nice. I mean, I can remember doing rates. Before I was CEO, I was a marketing person in the 90s and early 2000s. And when I was doing marketing, I can remember doing rates at 5.5%, 6%. And they didn't quite get to 6% this time, but they got up to 5.5%, 5.25% again, which was a nice season. So again, going back to the example of my parents, when the rates were high, I was telling my folks, I said, if you have money that you want to invest, do it now because the rates are not going to stay this high. And I'm saying the same thing now while rates are still in the fours, which is a fine rate. Rates in the 4% range are fine, but they're not going to stay there very long. So um, if you're looking for rates in the fours and you can go out a year, 18 months and get some rates in the fours, you'll thank yourself probably in about a year from now because rates are probably going to be in the
Right.
threes again. Yeah,
Right. So, I mean, not that we can speak for all the banks out there, but what the heck, let's have the conversation.
sure.
So all of these banks that were offering like high yield savings accounts, I guess that would be the expression. So many banks were, and they were like in the 4.25, 4.5, just as a regular savings account. So would you think though, would those wind up dropping as well?
Yeah, they probably will. I can tell you that we did not drop ours. We had our rate meeting on Friday after the Fed had their meeting on Wednesday, and we dropped some CD rates, but we did not touch our savings rates. So we still have what's called an Accelerate savings account that pays 4.15% on the first $15,000 in the account. However, all savings accounts, I shouldn't say all, there may be exceptions out there I'm not aware of, but all savings accounts are variable rate accounts, unlike certificates. CDs, you lock in that rate. That's not changing. What you get is
Yeah.
what you get. Savings accounts are variable rate accounts. So those are subject to change and will eventually lower as these rates come down because we at financial institutions are looking to manage our margins, right? So if we're if we're not able to invest as much, we have to bring down the rates that we're offering to consumers or it becomes a loss position for us. Right now, the rates are still high enough where we didn't have to do that. And we made the decision to continue with our 4.15% on the accelerate savings. We actually made the decision to stay with our 5.12% rate on our platinum rate rewards checking account. And that's also on the first $15,000 on deposit, provided some criteria are made, like X amount of debit card purchases per month and a couple other criteria. But we decided to keep those rates parked at the very high rate for now.
For now.
For now, full disclosure, for now.
So what would you want to say to folks who are listening that are now we understand that if maybe you have a CD coming due, maybe you were locked in that rate, it's
Mhm.
ending. Um what should we do as consumers? Not, I mean, not that we're putting all of this
Yep.
on you, but just what do we need to be aware of right now when this is happening?
I would say just do your homework. Take a look at the rates out there. Look in advance if you know you've got some CDs maturing. Um, doesn't hurt to if we're your financial institution, which hopefully we are. If we're your financial institution, give us a call and say, I have a CD maturing in 2 weeks or whatever. Can I lock in on a rate if you see something now? People like us, we may say, well, your CD is not maturing for 2 more weeks, but you know what? I'll give you this rate that we're offering now, even if they drop again before you mature. It's worth it to do your homework, send a couple extra emails, make a couple extra calls, and know what's out there. That way you're sure. Because the benefit of certificates, CDs, is that you are locked into the rate as we talked about before. And the other benefit is you are insured up to $500,000. And another benefit is your principal is never at risk. So some people now may, especially a younger demographic, I would say young adults particularly, may fall in love with the stock market here and say, I can make so much more in the stock market on certain things. And maybe you could. but your principal's at risk. So if something ever went crazy, you could actually lose your money, which you never do with a certificate or a CD.
So for those out there who are saying to themselves, gee, I have a certificate at X bank and I'm not sure when it's coming due, I would think the bank is going to notify you. It's not going to, you're not going to have a surprise, right? Or
Well,
am I wrong? Am I wrong about that? Do
well,
you
no,
believe
there's a
that you would
little
be
bit of
proactive?
incumbent. There is a little bit of incumbency on the consumer to see what the rate is because most certificates do automatically renew, right?
Oh, all right, good to
But
know.
this is why it's good to call us or your bank. It's good to
Yes,
call. No one's going to bite anybody's head off for calling and asking because
right.
what winds up happening is when you let's say you're in a 1 year certificate. Well, let's say I have a special on a 15-month certificate where that's a better rate than the 12. Now, if you don't check out our website or call us, you may renew into the 12-month again, which would possibly be a lower rate, could possibly be a higher rate, but it could be lower. So you want to call and do your homework on it to say, oh, I see you have a 15-month. Can I roll my 12-month into a 15-month to get that better rate? And the answer is always going to be yes. So you do have to do, everyone, I recommend do a little bit of homework on that and see what's out there and say, if you've got a CD maturing, especially now as rates are coming down, give a call and say, what's the best you can do for me?
So I guess now more than ever is the time to do a little bit of internet
Yep.
sleuthing and see what your bank is offering, what's the best rate for you. And if you're looking to get a car loan, to get a mortgage, I guess, well, like you said, if you can hold out a little bit longer,
Yeah,
you
you
might
might
be able
reap some
to,
additional benefits.
yeah,
Now, if you desperately need a car, rates came down a little bit last week. So rates
okay,
did come down a little bit, but they are starting to come down. And you certainly don't want to be without a car if you don't have to be. So
right.
so this may be the right time. But if it's not, if it's more of a luxury as opposed to a necessity, you may want to wait a little bit.
All right. Well, Mike, thank you for all this info. See, I feel like, I'm asking the same questions that most people out there would ask.
Yeah.
This is not my area of expertise at all. And I didn't really understand, well, you hear this in the news, but how does it filter down to the average consumer? So I guess the broad answer is if you want to borrow money, it's great. If you're a saver, you better check the rates.
Yeah. Yeah. Because
Bottom
they
line,
unfortunately are always directly tied, loan rates down, deposit rates down, and up and up. That's why loan rates have been high for a long time now, and unfortunately, that's hurt the real estate market for a lot of first-time buyers, especially because rates have been so high. And for the first time that I remember in my lifetime, I'm going to be 54 years old next month, and first time in my lifetime, I remember a situation where interest rates were high and kept going up on the loan side, and property values did not come down. Usually those have an inverse relationship too. Interest rates go up, property values go down. This was a rare situation where both stayed high, which hurt a lot of first-time home buyers.
right? All right, well, lots of information. You want to stay current, watch the news, check with your bank, see what's the best for you. Look for something in the fours. That's my takeaway here.
It
Look
is
for
for
something in the
this
fours.
time. If you can get the fours, that is my recommendation. Mike Powers' personal recommendation.
Yeah,
But
you heard it here, the
but
crystal
but
ball.
I strongly recommend everybody do what's best for them and make their own financial decisions that are prudent to their particular situation.
Because everyone's situation is different. Yes,
Absolutely.
absolutely. All right, so we've been speaking with Mike Powers, President and CEO of Garden Savings Federal Credit Union. We'll have all the info out there in the descriptions if you want to reach out, check their rates. And thank you for being my guest today.
Thank you for having me. As always, I always enjoy these conversations.
Thank you. All right, remember, if it's important to you, it's important to us. I'm Andrea Tarr. We'll see you next time on Scan FYI. Bye, everyone, and bye, Mike.
Bye.